Hello. In this clip, we'll be looking at understanding double entry principle. Not just understanding it, knowing how to apply them whenever they arise in any of our financial transactions. So, double entry principle. And this principle is most likely telling us that we have two accounts. We have the giver and the receiver. So they say debit the receiver and credit the giver. How do you know the receiver and how do you know the giver? Of course, it's understandable. But I have a formula here that I think most of you are conversant with, but I will help broaden it now, which is dear clip. Dear clip. So it goes like this. We have dear and we have clip. The dear D stand for drawings. E stand for expenses. A stand for asset. R stand for receivables. In receivables, you can have debtor. It's also a receivable. For the C, this is called capital or equity or owner's contribution. Then L is liability. I is income. P is payable. Then the other P is provision. Dear clip. Now for the dear, there are the debit entries. So their balance brought forward is always at the debit. So but for the clip, their balance brought forward is at the credit side. So it means for the dear, you have the debit side being favorable. Their balance brought forward or any posting to the debit side of this dear, it means it is increasing. It is increasing. So if you post to the debit side of any of these DEAR, it means they are increasing. If you post to the credit side of any of these CLIPP, it means it is also increasing. But in this case, if you post to the credit side of a debit balance brought forward account, like drawings, any expenses you can think about, be it operational expenses or direct costs or any expenses or assets or receivables, if you post to the credit side of these accounts is unfavorable. It means it is reducing it. So in any equation, in any account you are encountered with, try and understand. This question is, for example, if I receive cash, I would think maybe if I receive payment for a good I sell, if I receive payment, it means money came in. It is favorable for the bank, and bank is an asset. So it means I'm supposed to post to the debit side of the bank account, which is favorable. But in the case whereby we are told that we incurred an expenses from bank, so our bank balance reduces. Our bank balance reduces. Remember, bank is an asset. If you go to your asset category, we have non-current assets and we have current assets. Bank or cash and cash equivalent is under recognized as an asset. Cash and cash equivalent is other current asset under the normal asset. So it means if your bank balance or cash and cash equivalent is reducing, it means it's unfavorable. So it means you should post to the credit side of such account. I'm just trying to give a preamble before we check what these things mean. Now, if you go to the credit balance, it means if I'm to open my capital account and we are given a question and the capital account has a figure if I'm opening a ledger for my capital account, the balance brought forward is going to be on the credit side. So for instance, if I say capital, it will be balance brought forward X amount. This is the right way to do it. Then similarly, any of these items, clip, their balance brought forward is always at the credit side because these are credit balance accounts. Then if you come to there, now let me mention income liability can be current or non-current. It can be loan, bank loan for more than 5 years, 2 years, or more than 1 year. It can also be current, buying on credit or accrual. Income is, of course, is one way. Any revenue you generate from for the business is also income. Payable, you are owing someone, is also provisions. When you make provision for depreciation, provision for bad and doubtful debt, and any other provisions are like those are the items that whenever you see them in a question and you are asked to prepare a ledger, once you open them and you already have the provision, you have these items with their figures. Once you open, it means their balance brought forward. If they have figures, their balance brought forward will be at the credit side. But when you come to these items here for drawings, expense, asset, and which is there, their balance brought forward is always at the debit side. So drawings is opposite of capital in the kind of way where you are withdrawing your capital. So when you are withdrawing, is receiving, you debit. Expenses, any expense, insurance expense, rent expense, salary and wages expense, name it, all of them. Raw material, you purchase the raw material, anything. The expense you incur, you have then your asset. Of course, raw materials and asset, right? The expense here, the asset here can be your property PPE, property plant and equipment, and any other. In fact, even your receivable is under asset, right? So I'm just trying to bring some item. Your payable is under liability also. I understand, but I'm trying to make it more clearer so that we understand this double entry. I'm giving a preamble before we now go into the double entry principle. Similarly, your receivables, they have their balance brought forward. But if there is a transaction that is reducing your drawings, that is reducing your expenses, that is reducing your asset or receivables, it should go to the credit side because credit side is unfavorable posting for this there. Now, similarly, when you have your capital account, your clip, which is on the credit side as a balance brought forward, if there is a reduction or an unfavorable transaction that occur, let me give an instance. For drawings, drawings is the opposite of capital. So if you are withdrawing and you are investing back, it's the opposite. So it's going. This drawing is affecting capital directly though. And expenses. When you're incurring an expenses, you're incurring expenses, salary and wages, you put to the debit. Maybe there is a return, maybe there is a reduction, maybe you paid someone excess and you have to reverse that payment. You have to go to the credit side to enter that transaction so that it will balance, it will net off. For instance, if you incur an expense of 1,000 and it happened that in this 1,000 you overpaid a particular staff maybe by 100 and you want to, I'm just giving an instance, I want to get back that 100 from that staff, you have to put that 100 here. The reason why you put that 100 here is like an equilibrium where you have both sides weighing. So here is higher than this side, but of course with a balance of 900. So you're now having a balance brought down of 900, no longer 1,000. But what if I decide to record that 100, which is supposed to be a reduction? I decide to record it here. This is going to give us a balancing. This side is higher than 1,100. Here is empty. In order for these two to be balanced, I have to record 1,100. It's not reducing, it actually increased. So it means when you are posting to the other side of the account, that is when it will reduce the balance. Now, this is just giving us a preamble of what the debit balance account is and the credit balance. Now let's go to giving and receiving. Debit the giver, debit the receiver, sorry, and credit the giver. So let's give an instance. Now let's start with drawings. if you withdraw money from your bank account, from your capital, not the withdrawal of a bank. I'm talking about from your capital. So you've made profits, you've made a lot of money, and you decide, okay, I want to pay myself as the owner. I want to not through channel of salary. I want to just let me buy some things for myself from the business money. You understand? You are withdrawing from the capital you've invested into the business. So why is it going to the debit side? Let's check. So if you have your capital is normally this credits and this debits. Capital is normally here. So let's say you have a balance of 1,000 and there's the drawings. There's the drawings of 500 or let's just say 300. So the drawings is going to be here. Drawings, which is 300. Now in the capital account here, our so now the balance is going to be 700. This is the balance carried down. Now, drawings cannot just stand on its own. Drawings is here to reduce the capital you've introduced. Another way you can call these drawings is not just by the name drawing. So I can decide to withdraw an asset. I can decide to, okay, one of the company's asset. I can decide to make use of the company asset, right? So in that case, it's going to be reflecting, this drawing is just a name to categorize any withdrawal that a businessman is doing from the business. The drawings can come in cash in the form of cash, can come in the form of asset, maybe PPE. It can come in any form that you are bringing out money from you are bringing out a value from the business for your own personal consumption, being the owner. So in that case, we will not look at the drawing as a name drawing. We are going to look at it maybe as a PPE, maybe as a cash, or the likes. So if we have a credit balance of 1,000 and we have a debit balance, so let's say these drawings, the name is PPE. Remember, it is drawings being that we are withdrawing something, right? So it's PPE. Now we are debiting this capital account by 300. Remember, I told you a credit balance account is on the credit side that is favorable, but on the debit side is not favorable. The credit side increases the account, debit side decreases the account, unlike the other way around. Now, where will this posting go to? So if I go to my PPE, where can we bring in debit the receiver and credit the giver? The PPE, the corresponding credit entry. So every debit entry has a corresponding credit entry. So the corresponding entry is going to be showing capital as a 300. Why is it showing capital? Because it's coming from the capital. Then when you're under capital, you name it as PP because that's what you are withdrawing. Then when you go to PP, you also name it as capital. You are trying to tell us that this is a withdrawal that was made from the capital account. Now, how is this? Who is the giver? PPE is giving. PPE is giving. That's why you are crediting PPE here by 300. And the capital is receiving here. Capital, this capital here is you, represents you. In fact, let me say explain very further. Capital represents the owner of the business. I am the owner of the business. That is, instead of putting my name here as Abdul, we just name it as capital. Now, I gave this money 1,000 to the business. That's why it's showing as a credit balance. I'm giving, so you are crediting the giver. That's why we have credited this capital account. Now I am receiving an equipment worth 300. That is, this is still me. This is still me. This is still Abdul. That's why I'm receiving on the debit side the 300. So credit the giver I gave the 1,000 as input, as the money I invested into the business. But if you remember the last class, we I said you are different from the business under business entity concept. So this capital represents me, and I'm giving out 1,000 to the business. So you are crediting me. So instead of this can still be called Abdul, right? Now I decided to withdraw 300 worth of equipment. So I'm receiving these PPE. So that's why you are debiting me this time around. But who is giving me that PPE? PPE is reducing. Remember I said PPE is an asset. So asset has debit balances. The debit side is favorable. It increases it. But the credit side is unfavorable. It reduces the value. So that is why you see that the credit transaction, the transaction is going to the credit side of the PP, which is unfavorable to the PP being an asset, being a debit balance account. I don't know if you can mix that. Whereas the capital here he appreciated by 1,000 initially when I introduced 1,000 to the business, but now it's reducing by 300. That's what I posted to the debit side of my account, leaving also the balance of 700. Now imagine this PPE had a balance on the information we are given. The balance is going to be reflected on the debit side because it is an asset. An asset falls under a debit balance brought forward. So I now put, let's say, 1.5. What do you think just happened? By the time the equilibrium here is higher than this side, you have to balance. You have to balance it. And you're balancing it with 1, 2 at the other side. So here has to be 1, 2, and here has to be 1, 2. So this balance carry down, and then balance brought down 1, 2. It has reduced from 1.5 to 1, 2. Why? Because there is a credit posting. So now we are crediting the giver and debiting the receiver. So this is just one part of it. Now let's hold ahead. So it's going to be an interesting class. See, okay. So we just kind of treated drawings and capital with a little bit of asset. So let's now go to expense. So let's say we incur an expense worth 1.5, right? And this expense was incurred from the bank account. So what do we do? We paid rent worth 500. So I'm going to open rent account. This rent is an expenses. Now when we are paying for rent, what are we doing? Something is giving and something is receiving. When you pay for rent, cash leaves your hand. Rent receives the amount because this rent account is used to track all the money you've paid for rent. So rent is an expense, while the cash you incur is an asset, which is cash and cash equivalent, which is under asset here. So now I'm going to have cash and rent. Now debit the receiver, credit the giver. So here I'm going to put 1.5 because I'm spending to where? To rent. So that's why I have to name it rent. Because if I'm looking at my cash book, I want to be able to know what this 1.5 was meant for, which is for rent. And I also go to rent account and indicate that something came in from cash. That's why we're debiting it here. So we'll now name it cash. I have to name it cash, indicate that the money is coming from cash by 1.5. Here we are crediting the giver and we are debiting the receiver. Rent is accumulating. We are recording the expense we've incurred on rent. Cash is also reducing because we are recording the how do we follow that up? Let's see. So let's say we have balances. So remember, rent is an expense. The balance brought forward, favorable balance brought forward is on the debit side. Cash is an asset. Favorable balance brought forward is also on the debit side. So let's say we have a balance brought forward of 200, and I have a balance brought forward of 500. Let's see what happened. So 200 was here initially before 15 came in, and we posted to the debit side, which I say debit side is favorable. At the end of the day, our balance is going to be balance carried down of 17. It has increased from 15 to 17. What about our cash? Cash we have 500. Oh, sorry, let's put 25. We have 25 as our balance brought forward as our opening balance for cash, but we spent 15. Let's even balance and see what happened. So if you are balancing, the balance has to be on the credit side, showing balance carried down of 1000. Then balance brought down 1000. Similarly, balance brought down 17. Rent increased by to 15 to 17. Cash reduced by 15 to 1000. So it means coming back to this principle of my dear clip. I say debit is favorable. When we posted to the debit side, it increased it to 17. Credit is unfavorable. When we posted to the credit side of an asset, it reduces it to 1000. Okay, so let's pick another. Then at the end of this, we are going to do a trial balance to see. Let's apply this principle to see if it works or not. Now, the next one, we've done expenses, right? Expense from cash. So we link again asset and expense together. Then receivable. Let's say we sold to a customer on credit. Let's go to debtor now, account receivable. So what did we sell? If you sell, what happened? You've generated the revenue. So that gives us a touch on income and a touch on account receivable. So let's bring in income. Now, this is the most tricky part. Like, income is income. Income is supposed to receive. Why are we not debiting? We get there. Then receivable. So receivable here, if the name of this is representing the name of the customer or the client that you offer the service to on credit or you sold goods to on credit. So now, which one are we debiting and which one are we crediting? So, but let's first of all deal with the balance brought forward. Remember, this is an income, and I told you the balance brought forward, favorable balance brought forward is on the credit side. So we're going to be having balance brought forward of let's say 1000. Now this is receivable. Receivable is a debit balance account, so it means our favorable balance should be at the debit side. So we have balance brought forward of let's say 15. So we've dealt with the transaction now from the beginning of balance brought forward. Now, why is it on the credit side and why is it favorable on the credit side? Now, we've incurred the transaction now and we sold on credit worth 700. So, which one is giving and which one is receiving? Let's first of all go to the one that is receiving. The receivable is the customer or the client. So, the client is actually receiving goods worth 700 from you, from me. So I'm debiting the receiver. How is this income the giver? Yes, income is the giver because I generated that money from our revenue. Don't look at the word income. Income, if you look at it from this other perspective, that income is what generates the money that comes in. So income is the one giving us that money as a result of the transaction that occurs. So that is why income is given. Let's not use the income. Okay, let's use revenue. Revenue, we are generating revenue. So revenue is saying, okay, take, I receive. So income here is the giver. Without the income, there cannot be an income. I don't know if you understand. Without the income account, there cannot be an income. So it is from the income that the income comes in, the revenue comes in. So income gives the money that or the transaction for this to occur. This is on credit. I'm also going to do on cash. So let's say it is cash instead. So we carry out a transaction of sales and receive cash. So here now we have credit and we have debit. So cash balance is an asset. So the balance is at the debit side, favorable balance. So we have it at the debit side. So let's say we have 1, 2. So if we also have this income, so let me finish with this one. So this is an account receivable. We have 700. So this our income at the end of the day. we will balance it, balance carry down of 17. If we have 1000 before as the value of the income that we generated, 700 has come to add to it. So we are having the balance brought down of 17. So we are debiting, we are crediting the giver, then we'll now do the balance, and we're debiting the receiver. We'll now do a balance. So balance carry down of 2, then balance brought down of 2. You said at the end of the day, they'll still come back to their debit and credit. That is when it is favorable. What about the cash? So let's say we did the transaction on cash. It also means that the income is generating, is bringing in money, and we're also receiving the cash from this angle. So it's also going to increase to 1.9. Then balance brought down of 1.9. So this is another aspect. Please, if you have any question in this illustration that we are giving, feel free to drop it on the comment section. I will make sure we attend to those questions. So we've done for receivable, assets, expense, promise, capital, income. And let's go to liability. So let's say we took a loan from the bank. So loan we receive worth 1000. So what happened? In cash. So we have cash account and we have loan account. I told you loan is a liability. Now, who is the giver, who is the receiver is already clear. You are receiving, so start with the one that is easier for you to understand. So we are receiving cash as a result of loan of 1000. Loan is representing the bank. Bank is the one giving you this money. So that is the loan. So it's the giver and it's giving you in cash. Remember, this is a loan. The balance brought forward is going to be on the credit side. So if you have a balance brought forward of 1000, it means at the end of the day, you're having a balance carried down of 2000 and a balance brought down of 2000 at the end of the month or at the end of the day. So it has increased your amount to 2000. And let's say cash, you have a balance brought forward cash of 500. So at the end of the day, we have a balance carried down of 1.5. So, and a balance brought down of 1.5. It has also increased, both instances increased by value. So we've dealt with liability. Payable is when you buy from your customer on credit. So let's say you buy an equipment on credit. So you have PPE and you have payable. Payable is your creditor, from your supplier, the person you are buying from. So which one is receiving? Of course, start with the simple one. Your PPE is receiving because your fixed asset is increasing by a value. So we have fixed assets from payable. So fixed asset here, a balance brought forward will be here, just like we've been saying, it's an asset. So why for payable, the balance brought forward will be here. So X amount. So let's say 1000 again, and here is also 1000. So if we are going to receive an equipment from the payable, so it means we are owing this person 1000 before. Now we are now owing the person an additional, let's say 500. So you're going to have a balance carried down of 1.5, then balance brought down of 1.5. Please close this. The credit entry increases the balance. It's favorable for this account.